Hello, I'm Stephen Galpin and this is Property Question Time. This is the programme where you can have your property related questions answered by our team of property experts, and joining me today are Saul Conway, MD at AS Financial Mortgage Advisory Services. Thank you very much for joining us. I think it's your second show, so we obviously didn't kill you off first time around.
I'm glad to be back.
Good, great stuff. And Steve Eakins, Key Partner Director at Lumon, Overseas Currency Experts. Welcome to you too.
Thanks for the invite.
And again, you survived the first show, so back again. Good to have you both. I remember we had some very good questions and some very, very good answers from you, so thank you for that. Saul, let's start with you. There seems to be no shortage of buyers and adequate stock in many areas, so the only reason for the property market to stall would be the shortage of funding opportunities. Do the panel think that the revival of the 95 to 100% mortgage facility could be the real key to maintaining a strong market? Not without its dangers.
No, exactly. There could be some problems. But look, at the moment, the market seems strong anyway. I know we've had a lot of factors coming into play recently that give some indication that the market may not stay as strong as it has been. But for years now, we've had really good property price growth. And that suggests there's outstripping demand compared to supply. That suggests, therefore, people are able to buy. Why are they able to buy? Well, because actually there's been a proliferation of finance. More and more companies have come to the market for lots of different reasons. Specifically, there's been a lot of money around where people don't want to keep it in the bank, or institutions can't keep it, so they'd rather lend it out, and property is a relatively safe bet in terms of institutional lending. The government keep creating demand-side policy. Help to Buy, for example, is a product where they will lend relatively cheaply to an individual to put a deposit down on a property. So we've had a lot of demand. And therefore, I think going back to 95% to 100% mortgages probably would be detrimental. It'd be detrimental because the kind of individuals that'd be taking those mortgages probably are not ready to buy yet and now have the opportunity. And if there is any problem with the capital value of property, you've now created a whole sector of individuals who are over indebted. And let's be fair, at 95%, that's quite a high level of debt already. There are also more and more products coming to the market where people who have smaller deposits can get help. And that's not just Help to Buy. There are banks that will offer something called one of them offers Family Springboard, where the family can put money on deposit with the bank and the bank will lend extra money because of that. There are other private lenders who will do product where they top up between the 95% and 100%, often actually rather expensive. But that market is catered for right now. It's just a very niche market.
The cost of a deposit today, or the last 2 or 3 years, has been quite high. Mm. And I don't see how a young couple paying quite high rents can actually afford to save up the kind of deposits that are needed at 25 or 30%. And I personally think that has quite a restrictive effect on the market. But more importantly, although you say, look, 100% mortgages make somebody vulnerable to the sort of capital fluctuations, I mean, I take that point. But on the other hand, as we've discussed, I think in a previous programme, prices have gone up roughly 11% per annum across the board. So if you're borrowing 100%, but you're seeing a 10 or 11% inflation per annum, I'd sort of say, what's the bother?
But you're back into speculation rather than into home ownership. And I do absolutely understand. And look, if we did create an environment, let's say the government supported 100% mortgages with some guarantee like they've done in the past, and then therefore there was a proliferation of product in that, we're going to create more demand, we're going to create more house price growth. So in the short term, great. We've got people that weren't on the market into a property that's growing. But surely we have to consider more than just the people that can't buy today. What about the next generation and the next generation? And if we just keep encouraging house price growth, which politically I can understand is really good, we surely have to come unstuck at some point. And the modern world thinks, if you think about climate change or think about fuel costs, the modern world thinks about generations more. What is our future? And I just feel like 100% mortgages will create a future that we don't want.
Mm. I take your point, but I just, again, the other argument is I see one of the leading portals did a survey the other day, and they found that people who are selling green homes, providing they've got the corresponding EPC certificate, are getting roughly 16% more when they sell their properties. Now, I mean, so you've got green creating inflation, haven't you? Okay, you've got demand creating inflation, and the higher the rents go, which there's no question rents are going up quite steeply, that again is going to actually fuel demand for properties, isn't it, to buy. And I just wonder whether it's right that the government, there was a lot of talk when the Help to Buy scheme came out that it was helping developers rather more than purchasers, and I think there's some truth in that. But I don't know how much the government should be involved and how much we should just let market forces create and sustain a market, because I think you must agree that if developers can know they can sell their product, which usually is dependent on funding, they'll build as many houses as you want. You know, it's not an issue. You know, when we used to have Dave and George go out with their hard hats and their, you know, fluorescent jackets and say, we're going to build 250,000 new homes a year. You know, I always used to want to scream at the telly, who's we? You know, what do you mean we are going to build? Who are you? But if you let developers go, if you give them the funding to, well, the purchasers, the funding to buy the properties, then surely that's got to be good news.
I agree. I think we need to encourage supply side. The issue lies in politics. Politically, it's bad for a party or for a leader to say we're going to support these, what some people see as these rich fat cat property developers. And so they keep moving on to demand side and keep saying we'll support the poor individual that can't afford their own home. I would much rather a supply side policy where we say let's build as many properties as we can and slowly soften house prices. I don't want to crash, I just want them to slowly grow less over time, let inflation catch up and make it more affordable for everyone.
But you see, if you start to look at the morals and the sort of ethos behind doing all this sort of thing, when Thatcher introduced the right to buy, again, I looked at a survey the other day that said 75% of those houses that were bought under those schemes are now in the hands of buy-to-let owners. So actually, they didn't do much of a service at all. They just fueled the rental market.
And ironically, local housing authorities and councils are now renting property off private landlords to put council tenants in. So while that looked like it was aspirational and home ownership led, it's led to another issue. And unfortunately, progressive governments have also created an environment where buy-to-let is less attractive. So that means for people that do want to rent, their rents have gone up. So we create another problem and make it hard for them to save. So there's quite a lot of issues, quite a lot of factors one needs to think about in creating more home ownership.
So as we've done a two-way job in demolishing the market, we better move on to the next subject, I think. No, it's a very complex subject, isn't it? And it's very, very, I don't envy government ministers in having to try and get this right. That's why I just question overall whether they should in fact interfere too much and just let the market do as it wishes. What do you think, Steve?
Similar view, really. There's always a challenge, isn't there? Always a to and fro. There's also the argument around how long the political cycle is to make those political changes, to see the deliverable within a political cycle is quite a challenge and a considering factor for them too, I imagine.
And again, I think with almost 20 housing ministers in the last 10 years, it's probably not conducive to getting good, consistent policy, is it? Anyway, we better ask you your question, Steve. Whilst it may seem to be wanting the best of both worlds, if I pre-book a currency in which I want to use to purchase overseas property, is there any way I can limit the damage if I've made a mistake and reserved at either a too high or too low a level?
Good question. So a lot of clients will ask this when they're looking at buying internationally. Obviously, they've got that exposure that they need to manage. When's the right time to press the go button and lock in that exchange so they know the costs without having to kick themselves later thinking, oh, I should have waited. And that's the importance of dealing with people who will give you those informed information decisions and having those big conversations around what's the budget, what are the time frames. Traditionally, clients will do one of three things once they've had that consultative review, those conversations. Most will still go along the lines of, well, I've put down my offer now on the basis that I can afford it now at the current level. I don't want to wake up with someone new in number 10 and the market's changed and it will cost more money. So I'll lock it in within a relatively near time period. Others will perhaps go a hedge and say, and normally this is a couple perhaps that might have a different view of things, and they'll mirror their risk exposure to their capital exposure. This allows them to have an average weight trading, obviously, because they're doing it over multiple trades, but they need to obviously acknowledge that one of them will be the lowest.
Okay.
Or others will just go with a coin toss. Not as popular as it once upon a time was 20 odd years ago when I started, and that would in essence be wait until the request of the capital comes. But obviously at the moment the market moves a lot. So with regards to managing that risk, once you've locked in the level, you can't change it. So it's super important to engage with the right people forward thinking beforehand and have that big boy conversation with that spreadsheet, with your costs to make sure it's affordable.
Okay. So I know we've talked in a previous program about an FX company's reluctance really to offer sort of steerage to somebody on whether they should book forward or not. But at the moment, we've got a situation where the pound is really pretty low against the dollar, isn't it? I don't think I can remember it being that low. I mean, I can remember the days of it being two and a bit, to the pound. But I mean, would it not be a fairly obvious assumption that that's going to go rocketing up sooner or later? And wouldn't you sort of hedge on that basis?
Again, people will often come to us going, well, I'm going to wait. And you kind of ask the question, well, why do you think it's going to get better? And the response is normally, well, it was there a couple of weeks ago. It will probably go back. And when you actually press them to say, what's the economical argument behind that? What's the political view behind that? What event do you think is going to drive that? How much do you think that's going to move the market? And equally, what are the arguments that are going to move it down so they can make that informed decisions? Again, remains really important to make that informed view. No one can have that crystal ball to say that the market's going to go up or down, but information is really critical so they can be educated around, we're in the top couple of percent that we've seen in the last 6 months. We've seen a spike today. And as a result, it's cheaper now than when you first budgeted. So again, they can make that informed, educated decision as to manage that risk to reward ratio that they're under. Yeah,
I think you're right. I mean, it's not terribly safe to go looking backwards, is it? I mean, I know even probably 3 years ago now, I was looking at buying somewhere abroad, and the euro pound was 140, I think, or just about hit 140 as I was about to do it, and I changed my mind. And there we are at 119 now, and not really moving very much.
That's right, yeah. Well, we've got a war in Europe at the moment, making it rather challenging to decide what's going to happen and which way it's going to go. But it's around making that decision when you're looking at it. And also another considering factor is a lot of people who are coming to us and talking around buying a property abroad. This has been their dream and their aspiration for many, many years. And they've been budgeting on the prices that they saw once upon a time. So it's just making sure that they're aware that the rate of exchange might not be the best that it's been in 4 years, but it's near the best it's been in the last 6 months.
Yeah.
And attribute that value, that saving that they're seeing against an extra bedroom, a new kitchen, a car the other side of Europe to enjoy when they're out there. And this all just makes a big decision.
Okay, well, thank you both very much indeed. That's all we've got time for in this half of the show. So join me again after the break when we'll be asking Saul and Steve more of your questions. Hello and welcome back to part 2 of Property Question Time. I'm joined by Saul Conway and Steve Eakins, so let's get on with asking them the questions. Saul, could the panel advise me on the best type of mortgage for a first-time buyer, i.e. interest only or capital repayments? Pros and cons, please.
It's a good question, and with all of these questions, there's no specific right answer. It will depend on an individual circumstance. The advantage of interest only is that your monthly payments are going to be lower because you're only paying the interest of the mortgage. You're not reducing any of that capital sum. And that can give advantages in terms of when you're a first-time buyer, you might need to kit out the whole home. So it just gives you that little bit of extra cash per month while you're bedding into owning your first home, while you're bedding into those costs, especially if you sort of moved out from parents or something like that. If you've been renting, you're probably used to it. The main disadvantage, though, of course, is you're not reducing the mortgage. And what that can lead to over a very long time, if you keep that property for a long time, is obviously not having as much equity in there. And if you want to sell and rebuy, maybe making that more difficult. And of course, over the long term, it's going to be more costly for you because you're paying a higher amount of interest on a higher capital sum than paying it off. So therefore, for most people, capital and interest repayment is the lower risk route, the more sensible route. You're making extra savings, you're reducing your debt, which is a good place to be. So someone just has to understand the options and decide what's right for them. Also importantly, and this is important, interest only isn't available to everybody. And it's not necessarily if you're a first-time buyer or a second-time buyer, it's around loan to value and it's around income. Banks are relatively circumspect on giving interest only because it is a risk product, it's a sophisticated product. So they only want to give it to individuals they believe can either afford it or understand it. They're also worried because you're not reducing the mortgage or giving it to high loan to values. And as we've discussed previously, first-time buyers are normally looking for high loan to values. So normally the interest-only product won't even be available.
Okay. Well, what I'm going to say is this: if you're a first-time buyer and you take on an interest only, I mean, let's take, say, the first 5 years. Let's assume a typical family cycle. So you get married, you buy your first home, and it's probably those first 4 or 5 years. At some point in that, towards the latter end of that, you're going to have your first child, perhaps, and perhaps a need to move. Now, actually, during that first 5 years, the amount of capital you actually pay down is about zero, isn't it? Even if you're on a capital repayment mortgage. So I think I would say, well, why bother doing that? Why not just take interest only and let inflation do the rest?
It's a perfectly reasonable argument.
Okay.
But at some point, you have to bite the bullet and say, I'm going to pay off my mortgage, because you're going to get to a point where the kids have grown up and left and you're in that house, it's too big for you, you maybe want to downsize, you still need somewhere to live. And if house price growth doesn't go the way it's been, and bear in mind the past can't necessarily tell the future, you need to make sure you've got your equity. You need to make sure that you've reduced your mortgage and able to take down risk because you don't know what your income's going to do, and also to be able to maybe buy a smaller property or to have those advantages. So yes, for a period, especially as a first-time buyer or newly married, moving into a new home, for a period doing it is acceptable and makes sense. But there just has to come a point where the true cost of that mortgage you take on and start reducing it.
Okay. Oh, and what would be the criteria for a bank or a lender deciding on whether you were able to have an interest-only mortgage? What sort of thing would they look at?
So they're looking at lower loan to value, some as low as 50%.
Really?
There will be some banks that will say as long as you've got a 25% deposit, it's a little bit complicated, you can put 50% on interest only and 25% on capital and interest repayment. So what you're doing is reducing some of it, but leaving some on interest only. And that gives the bank comfort that if they do need to repossess or you need to sell, there'll be adequate equity in there for you to be able to move on. Other banks say, we need to understand what you're going to be doing with the money that you're not putting into your mortgage, i.e. have a savings vehicle or do something sensible with it so we know it's there if you do need to reduce your mortgage. And others are just happy that if you're a significant earner, maybe £100,000 plus, they're happy you're sophisticated enough to just take interest only. So different banks will have different criteria, but they generally are more niche in the market.
And again, as we've discussed before, a sort of good broker will steer you through that, no doubt.
Absolutely, you'll be having the conversations. Now, most mortgage advisors won't necessarily be able to advise you on what to do with the money you save, or you're not paying into your mortgage. You'd need a financial advisor or someone more financially savvy, but they'll be able to take you through the different products, the different criteria, and whether it's available to you.
Okay, all right, thank you for that. Steve, your question. It's a bit beyond me, this one, so I'm going to shut up and leave you to this. So I have a small export business and I'm looking to purchase a property in the United States to facilitate my warehousing and distribution needs. The financing will be charged in dollars, but I'm seeking a way of limiting the fluctuations that may occur in converting pounds to dollars throughout the period of the loan. Can the panel help, please? Can you?
We can,
Good,
yes.
okay.
Here we go. So again, this comes down to risk management. This comes down to budgeting and what the company is budgeted for that product, i.e. whether or not the margins are rich or poor in it, towards that risk-reward ratio that we've talked about before in previous episodes. In essence, it's, a lot of clients will be busy running their business and won't necessarily have the time to be constantly watching the market and being informed around the market. So engaging with specialists allows them to represent them in the market, be their eyes and ears, to highlight the peaks the spikes in the market, the risks that might be there around the corner, so they can have an informed, educated view as to when to lock in levels. Now, some people will have a very risk-averse approach to this and will perhaps take out a forward contract. We've talked about in a prior episode, I believe. So this was a buy now, pay later option, locking in that exchange rate so they know exactly what the cost is going to be for the full year. Others might be more open to risk, so they might do it on a monthly or a quarterly basis. Now, there'll be advantages and disadvantages against both, depending where the rate of exchange is, against whether or not the rate of exchange trends up or trends down in that pairing. And obviously that is always changing at the moment, so it's worth always keeping abreast of it. But doing more transfers means that they're getting a better average rate of exchange. So average is...
But more fees, presumably?
Not normally. Once upon a time there was, because there would be lots of transfer fees for making international payments. But as the world's evolved, that's becoming cheaper and cheaper. So that, especially if you're talking about volumes that most people are, the costs involved are nothing. Whereas the exchange rate volatility will often see 1% or 2% in the space of a week. And we've talked on this show around interest rate changes and inflation and everything else. The cost of earning that money, paying tax on that money to save that money, and you're talking about the exchange rate moving, how far that money is going to go in a matter of days. So having that informed decision is super important.
Okay, so I mean, on balance, let's take today's climate. What would you be suggesting? A sort of quarterly review, perhaps?
Again, it's case by case. Information is key, really. Understanding the client's requirements, the availability of capital within the business as well is going to be a crucial element as to how much they're going to be able to hedge forward. But in essence, engaging with a specialist, putting those rate alerts in place so that it's driven by the markets or driven by a political or economical event for that review is super crucial. But again, with markets, it's always changing.
You're quite strong on that, aren't you? The effect of political events on money. That really is the driver, isn't it?
It certainly is, especially with everything changing at the moment. People refer to it historically as kind of a currency compass. So there's a few different views, a few different impacts that will drive the market and therefore drive cost to a client, whether or not as a business or an individual. So that'll be political events, economical events, acts of God and acts of terror. So those kind of events will normally drive the market.
So just continuing, sort of expanding on the question, I'm presuming that it would also be wise to speak to UK brokers in this situation to see what the American property market was doing, what the value of that property they purchased in the States was, whether it had inflated over time, and maybe looking at a different source of funding rather than funding in the States.
It's an interesting question, and one that actually comes up quite a lot, specifically with the United States, because we're so closely aligned with them in the UK. And recently, and actually for quite a long period, the United States interest rates have been higher. So actually taking borrowing in the United States has been more expensive than taking borrowing here. Now, normally you need an asset within the jurisdiction. So to take borrowing here, you need the asset to borrow against in the UK, but not always.
Well, I was thinking in particular whether, at some point it may be worthwhile this particular viewer saying, right, well, the value of the property has gone up in the States. My property here's gone up in value. I wonder if I can borrow something on the property here and just pay off the borrowing in the States and have that as a cash asset.
Absolutely, and you're likely, because of FX risk and charges and other things, you're likely to be benefiting from that. So it would, of course, be down to case by case. But as I said, we have a lot of clients who do take borrowing here to pay off debt in the US because the rates there tend to be higher.
Well, I think the moral of this one is that these people need to talk to two people like yourselves and take some expert advice. And I think that's the key in a lot of property matters, isn't it? Have your experts around you and listen to what you're told.
One point I'd also add on that, if I may, is around if they're looking at raising capital, is where they're accruing the capital to repay that debt. Because obviously if they are, in your example, your proposal there around taking exposure in the US and raising capital there, then that product might be slightly cheaper at that point in time. But if you're repaying that with a UK asset flow, then obviously you're opening up to yourself to more exposure in the exchange rate. And as we've talked about on this episode and prior, cable price, the nickname for pound dollar, has gone down and down and down. So it's so much more expensive to buy those dollars now. You've got to be really conscious of that additional exposure as well. Again, comes back to that point around talking to people who've been doing it for a long time, so you can see all the angles and try and avoid as many pitfalls as possible.
Use the experts. That's the advice. Okay, guys, thank you very much indeed. I'm going to say a big thank you to you both. So, Steve Eakins, thank you. Saul Conway, thank you for coming in today. Fantastic answers. Very appreciative of all that. So, join me again next time on Property Question Time, when we'll be answering more of your questions.